Welcome to the podcast, Manaf Speaks Finance. My guest today is Andrew Goulter from Mattioli Woods Wealth Management. And I'm very excited to have him here today, and he can obviously discuss in terms of how he can help clients to invest their money. And so, Andrew, thank you. It's a pleasure to have you here.
Thanks for having me, Manaf.
So yes, obviously, we can, get some help and tips and advice from yourself.
Tips and free advice. I don't know if I give any of this stuff away for free, Manaf, but it's worth a shot.
Well,
thanks for having me.
Oh, it's truly sort of, pleasure to have you.
Sorry.
So, just tell me briefly how you got into the wealth management.
So it was a bit of a natural step for me. I got a degree in economics from Leicester University, and understanding finance was something wealth management and financial advice was something I was very interested in. Prior to becoming a financial advisor, I was a director of my own limited company and a general manager as well. So I kind of spent a long time understanding how business works hands-on, but never actually spent any time focusing on myself. I was much more focused on taking care of my staff, making sure the orders were fulfilled, paying the bills, just finding enough time to then chill out and go, right, I've got no stresses, I've got no concerns. But what that meant was I didn't look into things like protecting myself, putting money into a pension. I did a bit of it because I thought I had to. And when I stepped away from that company, I needed to make a change, and it was something that I felt I could relate to a lot of people that need to make those kind of decisions, but don't have the time and don't have the impetus to take care of themselves in that way. So joined Mattioli Woods. Took me a year to get qualified and to get my diploma in regulated financial planning. And then I've been an advisor on the road for the last 5 years.
Oh, fantastic. That's very exciting journey. So mixed and variety of experience, and you must have gained a lot of knowledge in doing different things.
Definitely. I think my favourite part of being in business and then being a financial advisor afterwards is getting to know people. And every person is different. Everyone's got their own story, their own journey, what they want to achieve, where they want to get to. And because of that, it's never dull. Everyone's got a different aim. And sometimes those products that we have to talk about are not necessarily the most exciting. Talking to someone about putting a will in place is never going to really set things on fire, but you have to.
Who says finance exciting? It's one of the stigma that we all have, that is dull and boring, but it helps save you a lot of tax.
Yeah, and more than that, like time and sleep. To know that your business is in the right position, your property's in the right position, that you've got a target and an objective and a goal that you can achieve. So I often say to people, like, when are you going to stop working? When are you going to stop working, Manaf?
Well, the way things are going.
70, 80, 90?
Yeah. As long as my brain's still ticking.
As long as the brain's still ticking. Yeah.
And body's still moving. Yeah.
Okay. Well, to me, I think it's really important to put like a line down for some people and just say, I need to be done by 60, because your business...
You've got to have a focus, and it's obviously focusing as to where your business is going, and obviously the long-term objectives. So again, like I said, that obviously this is where your expertise comes into it as to how best they can manage their future, dreams as such.
Yeah. And the key is often time. Yeah. You need to have time to plan. There's a lot of work that we have to do with allowances, and there are caps on those allowances, and you can only do so much in each year. So if we've got 1 year to react, we can't be as reactive as if we've got 10 years to react. I think
Right.
it's the old 18 quote. It's like, give me a minute, I'm good. Give me an hour, I'm great. Give me a week, and I'm unbeatable. You know, if we've actually got huge time scale,
Yeah.
we can work towards that little by little. You know,
Okay.
if you're going on a journey, you set a destination, and then you've got to figure out how you're going to get there. And if you're just going in a straight line, you're probably going to end up having an accident. So it's got to be flexible.
And that's why you're here today,
Excellent.
to make that journey easy, easy for our listeners. So now, so let's start with that. So starting the journey.
Mhm.
So let's look at the relevant life cover.
Okay.
So from your perspective, what's the advantages
Okay.
of having this, and for those business owners out there that probably may not even have that or never considered it. So
Yeah. So as a nation, we are usually under-insured. When you look at your liabilities, they're often just, I've got a mortgage. Okay. Well, actually, you know, if you're responsible for children, minors that need to get up to the age of 21, potentially to support a spouse, a husband or wife, there needs to be more protection to take care of them, because perhaps in a relationship things aren't necessarily equal.
Yeah. So if you put it in perspective, then let's say we're looking at a owned and managed company. So you've got one director, and every responsibility is on that individual.
Mhm.
So if he's there in the business, something happens to them. So this is really crucial for anyone in that situation.
Exactly. So everything depends on them. They might be the main breadwinner in the scenario, and they need to take care of themselves and the wider family if something were to happen. So what Relevant Life is a form of life assurance that's available to directors and business owners. It's specifically available to them because they're often not included in part of things like group life schemes. They tend to be for employees who will go into a certain type of protection policy or a death in service policy.
Okay.
The director can take out under Relevant Life usually up to about 20 times their combined salary and dividends. So if a client, if a director was taking perhaps £50,000 a year from their company,
Okay.
as £12,570 worth of income, and the balance as dividends, they could potentially take up to £1 million worth of life cover.
Right.
Okay. The type of policy is a life over another. The company takes out the policy over the life of the director, and as such the company pays the premiums in order to support the director. Okay.
Correct.
That means that those premiums are a tax deductible expense to the business that could come off the corporation tax liability if they are deemed to be wholly and exclusively for the purposes of business. Now, that's actually where our relationship comes in.
Yeah.
Because whilst I know the rules that are laid out here, I don't fill out the company tax return.
So something that may sound very expensive, actually, what you can save through the company
Mhm.
can obviously be very within the budgets of the individuals. So,
Exactly.
yeah.
The savings can be significant. It's
Yeah.
always circumstantial. So a client needs to look at their own health weightings. We need to understand if they're in a good place, because there might be extra premiums that need to be paid. But we always go and measure what the market wants to charge for this to make sure it's suitable. Okay.
Okay.
So we measure twice before we cut. You know, we've got to get it right. But if that client is taking out money as a basic rate taxpayer, or even a higher rate taxpayer because they're taking extra in order
Okay.
to pay for their own personal life assurance,
Yes.
the power of taking it out under the relevant life regime makes it much more tax efficient. And you know, it's a good way to provide protection, which you need to take
Yeah.
care of the family, to take care of everything you've built in your estate.
Family and the business as well. So obviously, if it's something does happen, then at least the relevant life cover will cover into certain aspects,
Yeah.
not everything, but to a certain degree.
So classically, the benefit of the relevant life policy will be paid out to a trust, which is outside of the business. But when the funds come into the possession of the beneficiaries, who are likely to be receiving the value of the company via the will, they've then got the ability to take the cash back into the company to provide protections.
Right.
There are a myriad of other protections. We could do an hours-long podcast on every other kind of life assurance that there is. Relevant life is one element, and the key is always suitability. So if you've got a concern, if you've got something you want to talk about, then the best thing to do is call the financial advisor, call me, go and find an IFA on the street, find someone who can, on the street, you know what I mean, find someone who
it's just a term used,
to sit and discuss these things, because if you don't know your options, you can't actually know what you want to go ahead with.
So as a professional advice, then it's like, I think generally it'll be for the clients or anyone who's running a business that doesn't have this in place, they should really look into it. Yeah. So, it wouldn't cost anything in asking, so they can get that advice, and then at least they're much better informed.
It's the kind of thing that we as financial advisors have to cover first. Our priority has always got to be to protect, before we then move on to those other elements that cover things like investments, that cover pensions or tax or anything else. Those are always bottom of the priority list. The most important thing is to take care of the person. Okay. So if you've got doubts, if you're not covered, if you've got liabilities outside the value of your company that you want to review, then pick up the phone. We can get some quotes, we can take a look at the scenario, and if it works out, if it's affordable, and if it's suitable for you, then you've got the freedom to say, let's go ahead with it.
That's perfect, and I think that's very valid and good points you raised. So now with this, and luckily it hasn't fallen.
Yeah, you've done well.
it's pretty good.
I'm a bit worried.
My heart's here of touching those. So
there we go. We're still good. Oh, you want me to? Okay, I'll take it out for you, Manaf.
Right. And now it just takes us to the next sort of wealth management side of things. Which is pensions.
Oh, we're on to the really sexy stuff now.
Pensions is such a vast area, and several different types of pensions. And like I said, we can be talking hours and days on these. So let's look at something that's more relevant for the clients nowadays. From your perspective, what's which pensions are actually the best way worthwhile?
Okay. It's hard to say things in a blanket circumstance, but in the round, pensions are incredibly important to everyone. Doesn't matter whether you're a director, an employee, someone who's self-employed. You have an opportunity. Okay. The key basics of pensions are that they give you tax relief on contribution,
which is everyone loves that.
Everyone, tax relief on contribution.
Who doesn't want that?
You get tax-free gains within the pension, so any returns within the pension are tax-free, and you get a flexible drawdown upon reaching retirement, meaning you can take 25% of the fund as tax-free payment, and then the balance at your marginal rate of income tax, and you can take as much or as little as you want. There are other ways that you can extricate the funds from a pension, but in short, you can start early, build up tax efficiently, and then flexibly access when you get there. Now, the thing I find the most commonly in pensions is that people become confused how they work and how they've evolved. There are a lot of misconceptions because pensions have changed massively, even just in the last sort of 10, 15 years. There's all sorts of headlines about the lifetime allowance, types of drawdown, SIPs, SASs, phrases, terminologies. It becomes jargon laden.
So there's so many things there. So obviously, again, for those individuals that don't understand, then they've got no idea as to what's the best thing for them. Yeah. And getting a right advisor that actually can overlook their position, I think there's very far in between who will actually provide that. And I think obviously being, obviously dealing with yourself,
Mhm.
I've seen that practically. So, which, I think, what we're talking now would be mostly, valuable information
Mhm.
for those that probably have got a bit of doubts on these.
You've got a limited selection of inputs when
Yeah.
it comes to pensions. The best thing that I would always suggest to people to do is remember that even if you're not enrolled in a pension now, you are if you're employed in the UK because you have a state pension. Okay?
Yeah.
You can check your state pension record on the government website. For those that are thinking of retiring in 10, 15 years or less, go and check your record. Make sure you've paid your national insurance contributions when you think you have. In the past, there's been processes called contracting out, where people have not necessarily made the national insurance contributions that they thought they had, and there could be a shortfall in your state pension. But the single tier state pension in this year equates to circa £10,600 per annum. That's the start of a basic income that you can build upon by deciding, where do I want to be when I retire? I need £25,000 a year net. Okay. If I know I've got state pension from 67, how much do I need to build up from contributions in order to pay me the difference? And then, do I want more than that? Do I want less than that? But the inputs are very basic. You've got the time until you want to retire. You've got the amount of contributions you want to make. And then investments are very, very tricky. But in short, you've got the amount of investment risk you want to take. Classically, the more risk you take over time, the more reward. But that is not guaranteed. And so you need to understand what's going on and what your journey, what your pathway looks like. Because if you're under contributing, could you do something a bit more? Could you say to your employer, if I'm putting in 8% of my salary, would you match me? Would you put in 8% as a contribution into my pension? Why would you do that? Well, it's a contribution directly into a fund that's tax-free, that's a deduction for the company, and it helps your pension build up quicker. So there are lots of different aspects to look at, little wins, that if you know what you're aiming for, you can make sure you focus on.
Well, that's a perfectly good way of putting it. So it all comes down to individuals' goals.
Exactly.
And so obviously that's personal pensions or occupational pensions. So just moving on to where there are companies who are cash rich in terms of they've got funds available and they just don't know what to do. So what sort of pension would you advise for those companies where they can put a decent amount of money into it?
Okay. So the annual allowance in this year is £60,000. This is the maximum that you could put into a pension in this tax year and receive tax relief. You've got to have qualifying earnings if you put it in personally, which means you need to be paid £60,000 worth of taxable income, not dividends, but taxable income to put it in personally. Or you can contribute on an employer basis, so it comes straight from the company into the pension. Okay. And as long as that is deemed by your accountant to be wholly and exclusively for the purposes of business, then that is a deduction to your corporation tax liability.
Right, that's good news to some people's ears.
Especially when corporation tax has gone up to 25% for some clients. That's a big difference maker. When it's in there in the pension, a lot of people become sort of it's disassociated from me. So what can I do with it? One very powerful piece of planning is to actually consider if you're a business owner that owns your own commercial property, actually purchasing that commercial property utilising your pension scheme. If you're using the right kind of pension, a self-invested personal pension or a small self-administered scheme, if it's allowable, and most importantly, if it's suitable, you potentially can buy that property from yourself.
Oh, that's amazing.
And be your own landlord. It's got to be something that's caveated with, you need the advice. Go and have a conversation with someone who knows what they're doing, because it's the kind of thing that can tie you in knots if you take it on halfway or you don't fully understand all of the risks there. Buying property, you know, if you need to liquidate it, how quickly can you sell it? There's liquidity risk, there's insurance risk, there's all sorts there.
So many factors.
But it's powerful.
Right. Okay. So as an example, then for our listeners, so if someone's got say £200,000 sitting in the bank, how would this work if they're investing into a SIP or a SAS?
Okay. So loose terms in this case.
Briefly.
Yeah. We've got a client who's got available annual allowance to do this. They contribute into the pension scheme. The pension scheme purchases the commercial property from the limited company. The limited company receives the cash from the purchase, and the pension scheme gets the property as an asset. A lease is then set up at a commercial rate, arm's length, RICS qualified surveyor to come in and say, yep, this is what it's worth. And a rent is then paid into the pension scheme in order to fund the pension over time, build up its value, which once again is a way of finessing the business to make sure it's being as tax efficient as possible.
Right. So briefly then, in a way, the cash that you've got, you're putting into the pension, but it's coming back to you again. In one respect, because the pension scheme is buying your property.
Yeah, that's the circle.
Yeah.
However, you've got to be aware of the elements. There's fees to pay. You're going to pay a solicitor to get that done.
Yeah.
So it's not a slam dunk, and it's a suitability case. You need to make sure you take the right advice to get the right possible outcome. But it's certainly something that's achievable and has been implemented in the past and will continue to be implemented in the future.
Yeah, this is helping many businesses. But like you said, advice is most important. That actually is suitable to your needs.
Exactly, and not just an advice from a financial advisor. You need to speak to your accountant. You need to get legal advice. There is a reason that we work together, Manaf, and we refer to solicitors, where we know where our lines are drawn and what we can and cannot advise on.
Correct. That's fine. I mean, obviously, this is where it's a two-way thing. So where we deal with we know our clients, what they where in financial terms, but obviously then this is where you come in and where you can say, well, okay, this is what are possibilities. So the clients get two professionals with different expertise, and that's actually that drives their dream going forward. So that's excellent. So obviously, moving on to something else from the pensions. Is the dreaded inheritance. Nobody wants to pay that.
Inheritance tax. What is it? The old quote is a voluntary levy paid by those who distrust their heirs more than they dislike the inland revenue. That's a very, very old quote from a former Chancellor of the Exchequer. In short, IHT is quite a big deal. It's becoming a bigger deal because all of the nil rate bands have been frozen. They're not going up, but inflation.
So what's the what's the nil band?
Okay.
So just to put them into sort of perspective.
So to inheritance tax, you have a nil rate band of £325,000, which you can pass on to the next generation before inheritance tax is levied. If you have suitable qualifying assets to utilise the residence nil rate band, this can provide up to another £175,000 worth of nil rate band. Added together, that's £500,000 per person, or as a husband and wife, as inheritance tax is only paid on transition down to the next generation rather than via spousal transfer. That's where you get the £1 million. You can pass on £1 million.
Okay.
But it's often misunderstood that people think that they automatically qualify for this. There are terms. The residence nil rate band requires you to have suitable property main residence to pass down to the next generation. If you don't, if you've heavily leveraged that property, you may not qualify for the relevant nil rate band, residence nil rate band. So, bit of advice is key. But in theory, as long as all of the ducks in a row, you can pass on £1 million to the next generation before inheritance tax is levied.
Okay.
But anything over that £1 million that's deemed to be part of your taxable estate is liable to 40% tax.
And this is where, with your expertise, you can help to minimize the inheritance tax liability, but going through a certain step-by-step process.
Exactly. There's lots of different ways to approach the issue of inheritance tax, and it's got to start with don't worry about it.
Yeah.
You as an individual don't pay inheritance tax. It's your beneficiaries that do. It's the kids' problem. I know you've got the boys in the company, Manaf,
Yeah.
so I'm sure you can create many issues for them. And a lot of people.
And now, it depends on, do you really want to leave those issues before them? So it depends on your conscience, and so if you don't, then
you need to take some action.
Yeah, you need to take action. Yeah.
The next most important action to remember is, you can preserve all these things, or you can go and make some memories. Go and spend it. You've worked for it. Go and enjoy your money. Yeah, it's important to make sure that you have actually had the best out of life. If you're sat there at 67 going, oh, I've slogged away and I've built up all this stuff and now I'm not getting anything from it, I just accrue some money and stuff, that's not going to satisfy you. You need more. So I do say to clients, it's important that you go out and enjoy it. Go on those big family holidays. Go and make some memories, take photos, do silly stuff. If you go and buy another property, the problem is that's still in your estate, potentially for inheritance tax purposes. So experiences can make a huge difference.
That's a good advice.
Yeah. Always think about it. There's no point suffering yourself for the sake of mitigating that HT.
Right. Okay. That's really it's opened up a few of my eyes as well on certain aspects of things. So it's been excellent discussing on these topics, which are always crucial because clients are always asking on these top three areas.
Yeah.
And so hopefully it's been a pleasure to have you here and discuss about the potential pitfalls that clients could actually fall in if they don't get the right advice or they don't speak to the right individuals. So sometimes how it is. They'll probably hear from a friend and etc. And obviously pick a few things and then start to implement certain things. So I think it's crucial for to pick up the phone or something.
Exactly. So
get in touch with us.
Most accountants, most solicitors, most IFAs or financial advisors will offer a free review. So I just encourage anyone who's got a question. That's definitely going down.
I'm listening to you. I'm
focusing on that. Yeah. Is to say, just pick up the phone, give someone a call, go and ask the right questions, and if it's going to be suitable for you, then it's going to be absolutely perfect. I can't wait for this to fall over.
That'll be next time.
But and anyone who's got any queries, just reach out. If you're losing a minute of sleep over something that can be solved in 30 seconds, then why? You take your time, but find a person that you trust, give them a call. It's still up.
It's still there.
It's still up. Come on, Manaf. It's on you.
I think we're near to the end of our conversation in terms of today's podcast. So now we shall concentrate on this game here and see
who wins.
If it's Mattioli Woods or if it's Emeka. Perfect timing.
It was. Thank you very much, Manaf. It's been a pleasure.
And it's been a pleasure having you. And thank you. And hopefully the listeners have got some value from this.
I hope so too.
Yeah.
All right.
Thank you. Yeah.
Cheers. Thanks.